Have you seen the headlines lately? I mean, the market is just all over the place. One minute the Dow is hitting a new all-time high, and then boom, a giant company like Meta absolutely tanks over 10%. If you're feeling a little bit of whiplash, trust me, you are not alone. It seems like everyone, from Wall Street pros to regular investors, is just scratching their heads right now. And get this, it turns out the guy steering the ship is just as confused. The head of the Federal Reserve, Jerome Powell, he just came out and said they're driving in the fog. Now, that's a pretty wild thing for him to admit, and it perfectly captures this deep uncertainty that's gripping the markets. So in this explainer, that's exactly what we're going to do. We're going to clear that fog. Okay, let's start with part one, driving in the fog. What is he really talking about? Well, it means the people in charge of our entire economy are basically flying blind. They're making these huge, multi-trillion-dollar decisions without any clear data to back them up. Because of government shutdowns and some major data changes, they just don't have a good read on the job market or where inflation is really heading. Their models, they're broken. And this lack of clarity, this fog, it leads us straight to our second point, what I'm calling Wall Street's Great Debate. This uncertainty has literally split the financial world right down the middle. You've got two camps, and they could not disagree more. Understanding their arguments is the first step to seeing what both of them might be missing. So on one side, you've got this soft landing crew, right? Think big firms like Goldman Sachs. They're looking at the Dow hitting new highs, they see these blowout earnings from AI companies like NVIDIA, and they're saying, see, the bull market is alive and kicking. But then, in the other corner, you've got the something will break camp. Guys like Mohamed El-Erian. They're arguing the Fed has already gone way too far, and they're pointing to the cracks that are already showing, like that crash in Meta or the stress we're seeing in smaller banks, as proof that a huge mistake is just around the corner. So there you have it, the great debate, the bulls versus the bears. But here's the question that really matters. What if both of these incredibly smart groups of people are so focused on their own arguments that they're completely watching the wrong ball? What if the real thing driving this market is something else entirely? And that question, that brings us to the very heart of our analysis today in part 3, the real indicator to watch. Because while both camps are busy arguing, we think they're both ignoring the one signal that truly holds the key to everything that happens next. Turn on the TV, read any financial news, and what do you hear? It's all about one thing. When is the Fed going to cut interest rates, right? Every single debate is centered on this one question. But what our analysis is showing is that this is a total distraction. It's noise designed to keep you from seeing the real story. So here it is. This is the crucial point. Ever since the big financial crisis back in 2008, markets haven't really been driven by the cost of money. That's interest rates. No. They've been driven by the quantity of money, by liquidity. And right now, that liquidity is disappearing fast. So how is this happening? Well, it's a process called quantitative tightening, or QT for short. Just think of it as the exact opposite of money printing. Instead of injecting cash into the system, the Fed is basically running a giant vacuum cleaner. They're letting old bonds expire, and when they do, that money just vanishes. It's being destroyed, sucking liquidity right out of the system. This is the real tightening that almost no one is talking about. And this leads us to our single biggest prediction. You see, the consensus on Wall Street is that this QT process, this liquidity drain, can just keep going for years. Our analysis says, no way, that's impossible. The financial system just can't handle it. We believe Jerome Powell is going to be forced to stop this process way sooner than anyone thinks. And our bet is before the middle of 2026 at the latest. And this is the key takeaway, so listen closely. Forget about that first little quarter-point interest rate cut. That's just noise. The second Powell even hints at slowing down or stopping QT, that is the real pivot. That is the green light that will unleash an absolute tidal wave of money back into the markets. Okay, so this brings us to part 4, the contrarian playbook. If we know that the real catalyst is the end of QT, then the next question is pretty obvious, isn't it? How do we get ready for it? Let's start with the classic safe havens, gold and silver. Now, first things first, let's just acknowledge what happened.
Precious metals just fell off a cliff. I mean, it was a brutal, painful sell-off, and now the mainstream media is absolutely filled with gloom and doom, warning everyone about a major correction.
But our contrarian view sees this completely differently. We believe what we just saw was not the start of some new bear market. Nope. We think it was a necessary technical shakeout to get rid of the weak hands. This brutal dip, in our view, was the final major buying opportunity before the next massive leg up. Why? Because while the price has been all over the place, the fundamental reasons to own gold are stronger than ever. Central banks are still buying it up at a record pace, trying to get away from the US dollar. Geopolitical risk? Well, that's only going up. And most importantly, that coming pivot on QT, that's the ultimate rocket fuel for precious metals. All right, now for what might be the most frustrating asset class on the planet right now, crypto. The number one thing I hear is, why is crypto lagging so bad? The Nasdaq is at all-time highs and my crypto portfolio is just stuck in the mud. And you know what? It's a totally fair question. So what is really going on here? Well, the answer lies in this one simple chart called Bitcoin dominance, or BTC.D. It's a really powerful metric that just measures how much of the entire crypto market cap belongs to Bitcoin. When this number is high, it means capital is scared, and it's all hiding in the king, Bitcoin. And here is our specific forecast. The crypto market isn't weak, it's coiling. It's like a spring being compressed, building up a ton of energy. We believe Bitcoin dominance is right at or very near its final peak, and when it finally breaks down, it's going to trigger a massive flow of money out of Bitcoin and into all the smaller cryptocurrencies. You might know it as an altcoin season, and we think it's going to be a big one. Okay, let's put all these pieces together. In our final section, we're going to clear the fog for good. While Wall Street is over there arguing about soft landings and recessions, our playbook is crystal clear because we're focused on the one indicator that truly matters. So here's the playbook, simplified into 3 steps. Step 1, the catalyst, the end of quantitative tightening. That's the real pivot. That is the green light for everything. Step 2, the core play. This brutal sell-off in gold and silver, we think it's the final shakeout and a truly historic buying opportunity. And finally, step 3, the asymmetric bet. That's a trade where your potential upside is just huge compared to your downside, is that crypto is building energy for an explosive altcoin rally. And the trigger will be Bitcoin dominance finally breaking down. Look, the main takeaway from all of this is actually pretty simple. You have to learn to ignore the day-to-day noise of interest rate debates and cable news drama. Instead, focus on the deep structural shifts that are happening with liquidity. That's where the real signal is. So that's how we're clearing the fog. The end of QT, that's the one event we're all watching. So is the bottom really in for gold? And is this frustrating sideways action in crypto, which is the calm before the storm? I'd love to know what you think. What's your game plan?